Hello traders, Gary Wagner here for Trending Markets. First day of February 2016, and we're looking at the Dow Jones Industrial Average, which was trading under pressure for the better part of the day. In fact, we had the Dow Jones Industrial Average trading down at around 16,300, 16,299 to be exact. It looks as though it's going to close in negative territory, slightly negative. It did go positive at one point today, 16,450, putting it off about 15 points, now 17 points on the day. We are going into settlement. Standard & Poor's 500 also was trading higher on the day. Of course, we did send out a trade alert as this market spiked up. You can really see that on this 13-minute chart in which we saw a trade to a high of about 1939. We're in at roughly 1932, so right in this area. We do have a little bit of settlement. My sense is that even if we do see this market backtrack a little bit, we should find support really in this area of 1928. Of course, what we did is we put our low below the low of the day, which I believe is around 1910. We'll talk about that as well as other markets pertaining to trending markets all on today's daily report. So traders, the first chart that I do want to look at on today's show is a simple candlestick chart, daily format, in which we basically have one fib retracement, and that fib retracement in essence covers the territory from just prior to the August meltdown right in this area here, roughly at 2109, down to the record low that we hit during the August meltdown. And then we get, of course, our different fib levels. We talked about the fact that when this market melted down once again, which of course occurred at the end of last year, beginning of this year, we had the market trading at roughly, call it 2078, 2076 in that area, and actually traded down to an intraday low that was absolutely below the prior low. And so we had this low right just above 1800. Of course, the real key was whether or not we would form a base or trade lower on this. And my sense was once we saw the fact that this market had really closed above that substantially, we felt that there was a real opportunity to make a play in the market. However, I wasn't going to make the recommendation. Now, we did go long today, but I wasn't going to make the recommendation till or if the market broke and began to trade above 1900, because 1900, that's our 78% retracement from this move down. And so when we saw this market move up on Friday, and tremendous strong triple-digit move in the Dow, but when we saw it move up on Friday, we did put out a conditional trade alert. And in essence, what we were saying is that if in fact we see Monday morning have some sort of strength, in other words, a positive move to the upside, and what I really want to see is the point in which it would take out 1937, but then we would enter the market. Now, if you take a look at this single candlestick, it doesn't really tell the tale. We'd have to break it down to an intraday. But as you can see, for the better part of the day, this market was trading under pressure. You can see that with this candle right here. Now, as I said, we really want to break this into components so you can see how it traded during the day. So traders, all I've done is converted our daily chart to a 240-minute chart. Each candle represents 4 hours of trading. And so when we do that, we can really break up our day, this being the beginning of the first right in here. So as you can see, for the first 4 hours in trading, the market did trade and trade lower. Then it actually on the next candle made a lower low, just slightly lower, but closed well above that. And then we were off to the races, because once we started to trade really over 1930, which was a current level of resistance, very, very short-term resistance right in here, the market did move. A nice little rally ensued, which took us above this key point of 1937. You can see that with this high here, only to track lower, right now trading roughly at about 1934 on the day. So traders, there's no doubt we had a couple of different markets that put some strong underlying pressure on the U.S. equities markets today, crude oil being one of them. After witnessing a pretty strong rally in which we saw the market trade to an intraday low, roughly at 26, to trade up and really not top out until it hit almost, I believe, 34.53 seems to be the highs that we saw in the marketplace itself. But after trading to that high, once again, we have the market under pressure, off 6.5% on the day, $2.20 lower a barrel at 31.41. Now, that coupled with the fact that there was some pretty tepid and weak economic data out of China put initial pressure on the U.S. equities markets. However, the interesting thing, and this is something that we have noted over the last couple of weeks, and that is that the equities markets here in the United States tend to trade in unison, or in sympathy, I should say, with crude oil till crude oil closes. Because when crude oil closes, of course, that's 2:30 Eastern Standard Time, there's still an hour and a half of trading left. And that's when we typically see the market trade on its own, taking away or not factoring in the pressure that oil has put on it. So that really has been something that's interesting. We do have crude trading lower on the day. S&P's final thought, it's trading, as I said, roughly at around 33 to 35. So we're going to go into the afternoon session. Maintain your current long position in the E-mini. Maintain your current stop. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.